Our third and final strategy, step 3, is about stepping out of cash using a portion of your funds to invest in timely bond opportunities, which may benefit from the market dislocations and recent policy initiatives. What do I mean by dislocations? Consider what has happened in the ongoing market crisis. For starters, certain securities have been mispriced as investors have fled anything remotely risky. And not just individual investors either. Major institutional investors have done the same thing on a much larger scale. That caused a sort of fire sale in prices of all sorts of bonds. So there are some good values to be found out there. And what do I mean by policy initiatives? Think about, for example, the government's massive investments that you have been hearing about in the news. The government is essentially making bridge loans to major banks. So that is where you could consider investing too. Why? Because even if the crisis stays bad or even gets worse, the government is not likely to sit by and watch their investments disappear. It is much easier to envision them putting even more money in if that were to happen, because they have the funds to do it and the desire not to lose what they have already invested. Consequently, these companies will likely get continued support from policymakers. Obviously, however, there are risks associated with these timely bond opportunities. So if you're going to participate in this Step 3 strategy, it is important to look for an experienced bond manager who has the reach and resources to take advantage of these opportunities while managing risks. One such manager is PIMCO, an Allianz Global Investors company and one of the world's leading fixed income managers. PIMCO is currently seeing opportunities in sectors that may benefit from the economic stimulus plan and current market conditions. Here are a few of them. High-quality investment-grade corporate bonds now offer uncommonly attractive yields. That is because tight credit conditions and ensuing policy responses have created significant value in the corporate sector. In fact, corporate bond spreads, the excess yields they offer over comparable treasuries, recently hit historically high levels. Agency mortgage-backed securities, MBS, are another opportunity in PIMCO's view. MBS are issued and/or insured by government agencies like Ginnie Mae and Fannie Mae, which in turn have the implicit backing of the U.S. government. As such, many MBS offer high credit quality, and they offer investors higher yields than equal maturity treasuries, which are overpriced. PIMCO sees an attractive opportunity in Treasury Inflation Protected Securities, TIPS. TIPS can offer a hedge against inflation, which PIMCO believes is likely to resume over the next few years, so purchasing TIPS now may protect you down the line. In addition, there has been a severe pricing dislocation in the TIPS market, as hedge funds were forced to sell these securities, which drove prices down. The U.S. government recently announced plans to purchase TIPS in large quantities, which bodes well for their future price appreciation. Municipal bonds, which offer income that is free from federal income taxes and in some cases state and local taxes as well, are the final timely opportunity I would like to discuss today. They have historically offered a high total return ratio compared with treasuries, and PIMCO believes they could be the next sector to benefit from the government's ongoing policy response. At the same time, there are a few bond sectors that PIMCO is avoiding. The first sector is treasuries. As we have discussed at several points, investors everywhere have been fleeing to the safety of treasuries. This has the unfortunate result of driving up their prices, which drives down their yields. As a result, PIMCO believes that investors are not being paid enough to buy these relatively pricey securities. Also, with inflation looming, the real return, or the after-inflation return, that Treasury investors could earn may be negative. The other sector that PIMCO talks about avoiding is high-yield or junk bonds. As a type of corporate bond, which we have just discussed, there are now some very attractive yields in the high-yield sector. But the problem, in PIMCO's view, is that the risk of defaults for high-yield bonds is too high, which means investors may not feel suitably compensated for this extra risk. Of course, this may change at some point in the future. So we have talked about why certain short-term and core bonds might be good in theory. We have also said that there are attractive and timely opportunities that exist in the bond market today. Now I would like to show you some hard and fast facts that should help you to put it all together. Spreads of bonds have widened to historic levels. This means that they are now offering high levels of excess returns over comparable treasuries. This inordinately high level of excess return, in the opinion of PIMCO and other experts, compensates you for the added risk. You can actually see a few interesting things if you look closely at this chart, which shows spreads of short-term bonds, core bonds, and investment-grade corporate bonds over the last 5 quarters, since January of 2009. First, remember that bond prices and yields move in opposite directions, so the high-yield spreads you see on the screen are caused by risk-averse investors fleeing these bonds, which according to the laws of supply and demand, causes their prices to fall. You can see this process illustrated in the chart in, for example, March of 2008, when Bear Stearns ran into trouble. Look at the jump in yields as investors fled these bond sectors. Yields jumped again starting in September of 2008, when the financial crisis spread to Lehman Brothers, AIG, and more. The yields on these bond sectors rose substantially over the next few months as investors ran away from anything risky for the safety of cash and treasuries. Remember, of course, what was happening to yields on T-bills during this time. A combination of investors' flight toward risk-free treasuries and the Fed's purposeful decision to keep rates low has led to the historically low returns on cash that we discussed earlier in the presentation. It all boils down to this. Over-investing in risk-free cash carries its own risks, the danger of not meeting critical financial goals. The good news is that the same crisis that has driven cash returns so low has created some timely bond opportunities for you, as you can see illustrated in this slide. Now you just need to decide if it's time for you to pursue these strategies for putting cash to work. So what are some steps you can take to put these strategies to good use? Work with a professional financial advisor who has the time, tools, and training to implement a complete financial strategy for you. One of the most pressing things you might want to talk to your advisor about is how much extra cash you have that you might allocate to bonds that we discussed in steps 1, 2, or 3. Remember that you need a certain amount of liquid cash for daily expenses and other pressing needs. But given the low returns and the looming impact of inflation and taxes, and given the risks of waiting for the perfect moment to put your excess cash back into the markets, you should reconsider using cash as a long-term investment vehicle and a substitute for a diversified financial strategy. Finally, you and your financial advisor may want to talk about which bond manager could best run your investment. Consider these factors. Active managers can seek to exploit bond market inefficiencies, manage risk through multiple strategies, and pursue opportunities regardless of market environment. Firms with deep resources and a good reputation can attract good talent and apply significant resources to technology and research. Well-respected firms with a history of innovation can go a long way toward helping you capitalize on the timely bond opportunities that we have been discussing. Risk management is one of the most important factors to consider before you choose a bond manager. All investing carries risks, but some managers integrate risk management into every decision they make, which can help you to protect your hard-earned money over time. With that, I would like to show you one more slide with important disclosure, and then you can email me with questions. Thank you.